So in our previous video, I introduced you guys to the Fibonacci tools, meaning the Fibonacci retracement and the Fibonacci extension, and well, showed you how to use those tools in order to predict our outside returns and also project our future levels of where price action should reach. Well, today we're going to teach you another simple pattern to go along with that. It's going to be the double top and double bottom. And this pattern can be used two separate ways. It can be used strictly as a counter trend trading opportunity, meaning that traders who are projecting the point where the trend is going to end and we'll see our next outside return, we can use that as an area to get involved at those key structure levels and at that key Fibonacci level. And this same pattern can also be used as an entry technique. So if you're a trend continuation trader that is, say, waiting for that outside return to come to a certain structural level and a certain Fibonacci retracement level, it's a way we can look at the market that's going to help us get a higher probability entry. And of course, we'll look at a few charts and go over both of those techniques later. But first, I want to teach you the actual setup of what a double top or a double bottom looks like. So the actual setup for a double top or double bottom pattern isn't too hard to identify. We'll see the market in a double top. We'll see the market push up. We'll come to an initial peak, so we'll create a new structure high. We'll then get a retracement. You'll then see the market retest that structure level before rolling over in the reverse direction. And you can see hence the word double top. We have one top right here. The market retraces a little bit. We put in another test. That test refuses to break and close above this initial structure level, and we roll down. The double bottom is the exact opposite. We'll see the market make a push down. We'll get a slight retracement. We'll then get a retest of that structure level before the market extends up to the high side, again giving us our first bottom right here on the initial move and our second bottom here on the retest. Now, there are a few filters in there that determine whether a double top is valid or invalid, and we'll go over that. We'll see, start for double top, we'll see the market moving up, moving up, moving up, and then we'll push up to here and we'll make our initial high right here. So this will be our initial high candle. This will be our new structure high, the candle that spikes up. Let's see if we can make this bullish trend. So let's make this green. Fill it in some. Give it some wicks. Let's do this. Thicken the candle some. There we go. So this is our initial high point. So if we're looking at the market, how I drew it before, this is that first spike. So again, and this is going to be our trigger bar. So depending on how price action reacts in the future to this bar is going to depend or determine, I should say, whether we're going to have a valid or an invalid double top. So after we get that initial high, we'll see the market retrace a little bit. So we'll see a few red candles down, let's say one completely sideways. Doesn't matter so much in this point. The key to this trade is going to be when we get a retest of this level. So eventually, the market is going to give us a bullish candle that's going to retest our initial one. Now here's the key. Just like the higher high, higher close principle, for a double top to be valid, price action has to do two things. First, the wick of the candle has to test the highest close of our trigger bar and cannot close above the highest high. So again, the wick of the candle has to at least test the highest close, so wherever this initial candle closes, and cannot retest the high or not break and close above the highest high. So if we're going to consider this, and I'll make this something that stands out to you guys. Make it another green one. If this is going to be our entry bar, here's what we need to be. If we get something like this, and this blue thing just being the wick again, if we get something like this is going to be invalid. Why? Or this is just this. If we get something like this, this is going to be invalid because we never test the highest close. If we get something like this where the wick tests this highest close, this is still a valid entry bar. If the wick comes all the way back up here, price action shoots and closes below here, this is still valid. Now, something that would make this invalid is this. If price action broke and closed above our initial trigger bar. And there's a PDF document in your training that has a picture of this so you can look at it a few times. But again, the key things you want to remember is this. Price action, the wick of the candle, at minimum, has to retest the highest close of our initial trigger bar and cannot create a higher high, higher close of our trigger bar's highest high, so our trigger bar's wick. And if we get a valid setup, and you can see this one would be, the wick spikes higher, but we don't close above, our entry is next bar market. And that means that as soon as this bar closes, and it's very important we wait until the close of this candle. So if we're on an hourly chart and it's 8:50 and you see the bar like this, we have to wait until the candle closes. We have to wait till 9 o'clock because we never know. In those last 10 minutes, we can spike up a lot higher. We can, anything can happen. So we want to wait for that confirmation of when the candlestick closes to enter. But after this candlestick closes and the next bar starts being created, this is the bar where we enter the market. So again, we have our initial trigger bar. The key identification levels we want to look at are where is the highest close. In this case, it's right here. You can see the close of this candle. And where is the highest high? And you can see it's right up here at the wick of this candle. After the market retraces, as we get a retest of this level, we need to at least, and at least meaning the wick of the candle, we need to at least test the highest close. Yet we cannot break and close above, so we cannot create a higher high, higher close above the highest high of our trigger bar. And it'd be the same thing in a downtrend. Market would be coming here, here, here. Let's say we get a big candle that spikes down. Bullish trend, so let's make this a red candle, or bearish trend I should say. Let's make this a red candle. Let's give it a wick. Let's give it a very small wick this time. And then again, we see the candle, market retraces, does a little jazz in here. Comes back down. And then eventually we get this. Now again, the key we're looking for is this area right here. In the case of a bearish trend, instead of looking for our highest close and our highest high, we're looking for our lowest close and our lowest low. So it's going to be in between the range of the close of this candle, this initial trigger bar, and then the lowest point of this wick. So if this were our candle right now we're looking to enter on, this scenario would be an invalid trade. Why? Because our wick never penetrates the lowest close. If we had something like this, this would be a valid setup because our wick penetrates the lowest close. It breaks the lowest low. However, you can see the candlestick does not close below it. If we had a situation like this, this is fine. If we had a situation like this, this is invalid. Why? Because we've just created a lower low, lower close. You can see the close of the candle closes beyond the lowest low of our trigger bar. So if we were to get an invalid signal, well, then we just have an invalid double bottom. We'd delete our charts of whatever we drew on, and wait to the next one. If we get a valid signal, how do we enter? Well, we enter next bar market. So as soon as this bar closes, and again, it's very important we wait for the close. As soon as this bar closes, we would then decide to enter next bar market. And look for the reversal. Okay, so let's look at a few on a chart, and then we'll come back and talk about two things: how these patterns are actually used, meaning when are you looking for these patterns, and then another filter to determine which double bottoms and which double tops are going to be higher probability opportunities than just a pattern simply sitting by itself. Okay, so if we look at the price chart, we'll see that these simple patterns form quite frequently, and we'll find our first example right here. And again, remember, we're trying to keep our eye out for this formation, two peaks, so like a mountaintop. And let's click through, and we'll identify it and roll through it as if we saw it in real time. So we're looking here. We have our initial top right here. Market pushes down. We get a retracement. We get a retracement. Spike back up. You can see we haven't quite gotten to this level yet. We need to, at minimum, get there for this to be a valid pattern. Spike up, boom. Market comes up. You can see we pass our structure high, or our highest close, right here. We don't close above our highest high. Now, even though the market wick spikes past it, we don't close above this highest high, giving us a valid double top pattern. And you can see the market rolls over right there. Top number one, top number two on the retest. Entry would have been at next bar market. So this would have been our entry bar right here, this green candle. As soon as this closes, and you see how important it is to make sure it closes, or to wait until it closes, because if we would have spiked a little bit up or closed a little bit further up, we would have had an invalid pattern. But we close within our zone, and well, the market rolls right over. If we zoom the chart out, let's see if we can find a few more. You can see another example down here. Market pushes down, pushes down, pushes down. We have our initial low point right here. And again, this point right now, we just want to get used to seeing the structure, right? We have our initial low point, our lowest close, our lowest low. Price action hits that point, retraces upwards, comes back down to retest. You can see this red candle right here, which would be our entry bar, closes well below our lowest close. However, we do not get a lower low, lower close beneath our lowest low, still making this valid. So again, it can close lower than our original entry candle. It can spike lower than our lowest close, or our lowest low. The thing that matters is how this candlestick closes, and it closes within our zone. We don't get a lower low, lower close, making it a valid double bottom. And of course, entry would be next bar market. Another one right here, pretty symmetrical one. Market pushes down, slight retracement, comes back down to retest that initial level, and then rallies up. Now you can see eventually this one rallies back down, but plenty of room to make profit if you were to take this as a trade. But this is a perfect, almost a perfect symmetrical example. It is a perfect symmetrical example of a double bottom pattern. See if we can find another double top. Clean one. Here's a nice clean one up here. You can see price action spikes up. We have our highest close. We have our highest high. Now, even though you can see this is important. Even though this candle spikes up here, This is not going to invalidate the pattern. The candlestick wicks can spike really wherever they want. It's not going to invalidate the pattern. However, it is going to create another higher high for us, even though this is a bearish candle. This is still going to be our highest point of the structure because we're looking at this pattern as in whole. So even though our trigger candle has a little wick and the next wick spikes a little higher than that, this is still going to be valid because this is our new high point of the entire pattern. So we spike up to our high point, market retraces down, we come back up to retest it. If I zoom in, it's not going to make it as pretty, but you're able to see the retest hopefully. Let's see if I can. There we go. You can see, what do? At minimum, we penetrate or touch our highest close right here in this bottom blue line. And in this case, we come nowhere close to even touching our highest high, giving us a valid double top pattern. Let's see if we can get one more. Told you guys, pretty simple. And it helps if you just scrunch up the charts if you're looking for them. We get a spike low, never get a double low. Here's a great example of a broken one. This will be a good one to show you. We see the market spikes up. We have our area right here, our highest close, our highest high. Market retraces. And then what do we get as we come up to retest this level? Boom. Higher high, higher close, making this an invalid pattern. Again, you can see our highest wicks are right here. Market breaks and closes above this level, making this an invalid pattern. Now this actually ended up being something else, a head and shoulders pattern, but that's something that we don't really worry about too much. But you can see when we get a higher high and a higher close, it's going to be an invalid setup. And the next candle, well, shoots right up. So now that you have a better idea of what the pattern looks like, let's talk about some filters. Because you're probably saying to yourself, okay, Akil, I understand the double top, double bottom. It looks pretty easy. A double top, we're just looking for basically two mountain peaks and then for the market to roll over. Or an M. For a double bottom, just looking for the same thing. Two peaks forming something like a W. But how do I know which ones are good, which ones are bad, when to take them? And that's when we start putting filters into our trading. And the first filter I'm going to put in for our double top, double bottom pattern is going to be our RSI, so our relative strength index indicator. So if you go to your indicator tools, and all charting packages should have the RSI. If your charting package doesn't for some reason, then you need to change charting packages because this is a basic, simple indicator. RSI. So I set my parameters a little different. Traditionally, you're going to see traders read about a 14 period or a 13 period RSI with the oversold and overbought levels being at 70 and 30. I personally don't care how you decide to do it. You can play around it, find something that works for you. Changing the parameters is just gonna change whether the market goes oversold faster on your chart or goes oversold slower. If you have a higher parameter that says 14 periods, basically it's going to take the last 14 bars instead of the last 7 bars. So I have it taking a little closer to recent price action. As far as overbought, oversold, I have mine at 80 and 20 because I want to see when the market is really, let's call it extremely overbought and oversold instead of just your traditional overbought and oversold. And this helps to filter out a few false signals. Now, whenever you go about filtering out false signals, you are going to miss trading opportunities. You're going to have those opportunities where man, if I had it on a 70 and a 30, it would have been overbought and I would have had a trade. But my whole philosophy is conserving capital. So I'd rather be more efficient and have higher probability trading opportunities than have more false signals that cause me to take a drawdown in my account. But anyway, the period I use is 7. The smoothing, you don't need to worry about that too much. I have it 1 just so it makes it a little easier on the eyes. For the lines, I have my lower line at 20, so my oversold condition is going to be at 20. And my upper is at 80, so my overbought condition is going to be at 80. And these oversold, overbought levels, they basically give you an idea of when the market is overextended. Now, I would say this. I don't want this to get into a lesson on the RSI. You can read about it on babypips.com, Google it. But just because the market hits an oversold or an overbought mark doesn't necessarily mean it's going to reverse. It's just a filter that we can use to add to some other filters in our trading to give us kind of a heads up. But I would refrain from selling every time the market passes 80 or buying every time the market passes 20. Because as you see, or as you will see when we put it on, the market can often hit those levels and then stay there. So we're going to bring in my RSI indicator. That's the thing here at the bottom. And we're going to make this condition, this filter in our trading. To have a valid trigger bar, remember the trigger bar is the first leg, the initial leg, this part right here. The initial leg, an initial candle in that double top or double bottom pattern. There we go. We're going to make a filter saying that initial trigger bar, the RSI needs to be oversold. So if we're scrolling through some examples, and I ran out of room here, see if I can get let's go to a different pair, euro dollar. So if we're scrolling through looking for double tops and double bottoms, we'll just scroll back to the beginning of this chart. We'll say this. You can see I have my initial trigger bar right here. The market pushes up, giving me my initial trigger bar. What do we notice on the RSI? Well, the RSI is over R80, so this is going to be considered overbought. So this is a filter. I'm only going to look for these trigger bars. I'm only going to look for the start of my double top pattern when the RSI goes overbought. And again, you can just look down, and as soon as it crosses this 80 line, it'll be overbought. So we retest as normal. Come back up. You can see the market doesn't close higher than our highest close, but the wick of the candle does penetrate that level, giving us a valid double top pattern, right? The next thing I'm looking for in my RSI is going to be called divergence, meaning that I essentially get equal highs here on the chart. You see if I draw a straight line through it, you'll see the wicks are right here. However, on my RSI, I'm going to get a lower high. And this is called RSI divergence or bearish divergence, meaning the chart is telling us one thing and the indicator is telling us something else. So two filters I'll use when looking for these double top patterns. Again, the first filter is I need the RSI to be overbought to have that initial starting leg, so that initial trigger bar. The market needs to be overbought at this level. Secondly, as we get our retest, I need to see divergence on the RSI. It doesn't matter if it's this low. This is an extreme case. It could be a little bit lower like this. That is fine. But those are two filters that I need in order to trade this double top pattern. And what that does is just puts me in higher probability situations again. It gives me a good sign. Hey, this is a level where the market is really likely to reverse at. Let's scroll through and see if we can find some more. Not if, when we find some more. These things happen all the time. Now look at this example down here. Market pushes down. Does the RSI go oversold at this level? Yes, we do. Right on this red bar. So at this point in time, I'm gearing myself up. I'm saying, okay, I have my trigger bar. The RSI is oversold. What am I looking for next? Well, I'm looking for a retracement. We get that right here. And now I'm looking for a retest of our initial structure level for that double bottom trade. But in this case, if you look closely, we don't have it. Why? Well, we never meet our double bottom rules. Price action never gets to our lowest close area. You can see? We never quite get there. So this is going to be a double bottom that I would pass on. Always want to throw in there one for you that isn't valid, just so you're just not seeing all the winners. Here's another example right here. Okay, there's actually two double tops right here. A smaller one, and again, if you just scroll through your charts, you'll see these over and over again. But we have a smaller one right here. We have our initial high. Let's look down at the RSI. RSI is overbought. We get a brief retest. And then we get a test right here. You can see the wick of the candle does penetrate the highest close. Obviously, the candle doesn't break and close above the highest high. RSI initially is right here. On the retest, we're right here. So we have some bearish divergence. And the market eventually retraces some. And this actually goes on to form an even bigger one right here. We get the same thing. Another double top right here. This level being our initial top. Again, RSI is overbought. We get our retracement right here. We get a retest, and this will be on a higher time frame, be easier to see this one. But same thing, look at that. On the retest, bearish divergence. We get a lower high on the RSI, and this ends up being a losing trade actually. But still the same valid double top right here, and this would be on a higher time frame. Let's get one more for you guys. Hopefully get a nice easy one. Never get a retest. You can see an invalid one right here. We get a lower low, lower close. Let's go down to a 60-minute chart. Here goes the example right. Nope. Okay. Before I get going, let me see if you can identify the double bottom on this chart. All right. Yep. We're looking right in here. You can see the market pushes down. We take a peek at our RSI. What do we notice? Boom. RSI is oversold. We get a retracement back up. We then get a retest of our initial low. Again, you can see the candle does not create a lower low, lower close. The wick pushes back our lowest low, but that's fine. As long as the candle doesn't close beneath there, still a valid pattern. What do we have on the RSI? Well, we have a higher low. So an equal move here on the price chart, a higher low here on the RSI. This is going to be bullish divergence, and well, giving us a valid double bottom. So now that you have a better idea of how to identify the double top and the double bottom pattern, let's go into a little more depth about how to actually trade it and where to look for these opportunities at. In this example, we'll take a look at this double bottom down here. You can see the market spikes down on our initial our impulse leg down. We come to our lowest low right here. And look at the RSI, we see we are also oversold, giving us the first trigger point of our double bottom pattern. We then get a retracement. Price action comes right back down to retest that original level. We can look on the RSI. Boom, again, RSI bullish divergence, giving us a higher low, yet an equal low on the price chart. So a valid double bottom to trade. Here's what we want to look for. And let's zoom this down in here. For entry, we talked about entry. entry is going to be next bar market as soon as our pattern is validated. So if we're looking at this level right here, we're looking for price action to retest our initial trigger bar. That would mean we're entering on this red candle right here. You can see the wick penetrates it, giving us an initial or giving us a valid double bottom. We're looking to enter next bar market. So in this case, this candle closes right here at, I'm not going to get a legit signal for you, but it closes right at this level. There we go. So here's going to be our entry, next bar market right at this blue line. To get our stops, I like to use an ATR based stop. Now, as long as your stop is below the low in this case of this this trigger bar, so the low of our structure, then you're good. I like to use an ATR stop just to make it more consistent, but feel free to experiment with different ideas if you have them. So I'll bring on another indicator, and it's the ATR, the average true range. This is another one that should be on every charting platform. If you don't have it, then again, you need to switch charting platforms right now. The default setting is usually 14. I'm going to match it up with my RSI, so put it at a 7. And the average true range, it basically gives you the idea of how much the market is moving on average, depending on what range you set it up for. So I'll bring my average true range indicator on, which is down here in green. And I'll look, what is the average true range on my entry bar? So this red candle right here is my entry bar. And if you look in my data box, it'll tell me that the average true range on this was 41 pips or 41 ticks. So I want to take that ATR 41. I want to find my lowest point of the structure. And remember, this point actually didn't complete yet because we're buying it as the market is about right there. So I take this point right here. I'm going to say 50.13 is my lowest low. So I'll take 50.13. Try that again. 5013 minus my ATR, which is 41. And that's where I'm going to look to put my stops. 49.72, which is right down here. So entries, stops, and you can use a one or two ATR if you want a little more breathing room. Just times that ATR by 2. So instead of putting it 41 ticks away from the low, you're putting it 82 ticks away from the low. But that's something you're going to experiment with in your own back testing. The key is you want to be below. You have to be below below the low point of this structure. For targets, I'm going to do this. I'm going to take my Fibonacci retracement tool from my last move. So this is the big move. Shoot down, boom, into our double bottom. I'm going to take my Fibonacci extension tool or retracement tool from the start of this move to the low of this move. And I'm going to look for my 382 as being target 1. And I'm going to look for my 618 as being target 2. Obviously, just with the stops, you can experiment with these, and if you're a more structure-based trader, you can take them off at structure levels, but as a default setting, a traditional setup, look for the 382 for target 1, look for the 618 for target 2. So again, entry is next bar market after your pattern is made valid. Stops, we're going to take the ATR, the average true range of the candle that made our pattern valid. We're then going to find the low of that structure area, so whatever the lowest wick is in this area, and we're going to subtract the ATR from that level to determine our stop loss. targets, Fibonacci retracement tool from our swing high to our swing low. We're going to look for the 382 for target 1 and the 618 for target 2 if you're using a two contract position size. If you're only using one contract, well, then the 382 is going to have to be it. Unless you do your back testing and again, you say that, hey, 618 is more profitable or 786 is more profitable or structure is more profitable. But right now, just worry about the entry, exit, and the traditional setup for targets and stops. Let's get one more example for you. I know some of you are like, that made no sense. Let's find, got to load more data on these charts. I don't really have much. Let's find a nice looking one, nice easy looking one. There's a few over here, but we're not going to meet the qualifications on the RSI. Here goes one, easy one. RSI does go overbought. Yep. All right. So we have our double top structure right here. Again, it should stand out for you by now. 1, 2. Look down our RSI. What do we have? RSI is overbought on our initial trigger bar. On the retest, look at that. Lower high on the RSI, giving us bearish divergence. Looks like we're good to go. So again, the candlestick that gives me a valid double top in this case is going to be this green one right here. You can see the wick penetrates the highest close. So I'm going to enter next bar market. So this would be my entry bar. I would enter right at the beginning of this red bar. So what I'm going to do is I'm going to take the ATR, the average true range, once again, of this green bar. This is the one that made my pattern valid. In this case, the average true range is 27. I'm going to look at the high of my structure. Where is the highest wick in this whole double top structure? Well, it's right here. So I'm going to find this highest wick. It's going to be at 63.07. Bring over my calculator. 63.07 plus, what did I say, 27, I think it was? Plus the ATR, let's say 27. 63.34. That's where I'm looking to put my stop loss. So 63.34 looks to be about right here. I'm going to eyeball it a little bit, but you guys should get the point. Now I have my entry, which is next bar market. I have my stop loss. So my protective stops, which is 1 ATR above the high of our structure. For my targets, taking the last move. So if we know how to measure our ebbs and flows again, oops, I'm going to take from this swing low to this swing high. I'm going to look for my 382 for target 1 and my 618 for target 2. Make sense? Hopefully it makes sense. Now, lastly, I want to talk about when to use this pattern. When do we use it? And it's gonna change up depending on if you're a counter trend trader or a trend continuation type trader. A trend continuation trader, here's what we're looking for. We know that the market ebbs and flows. Come on. Oh, there we go. Let me let's get these indicators off of here. Boom, boom. So we know that the market ebbs and flows when we're in a trend. We get new structure highs, outside returns. New structure highs, outside returns, new structure highs. As a trend trader, where are we looking to hop on the trend? Well, we're looking to hop on at one of these outside return levels, right? And this is going back to lesson 1 and lesson 2. So we know we want to enter at an outside return. We also know we have some filters. Where or how can we project and predict where our next outside return is going to come to? Well, the first thing we can look at is structure. Second thing we can do is take our Fibonacci retracement tool, swing low to swing high, and measure out a kill zone or a potential reversal zone between our structure level and our closest Fibonacci retracement. In this case, it's the 618 retracement. So now we have a zone of where we predicted the market to come back to an outside return. And here's how we implement the double bottom technique in this case. We'd wait for the market to come back down. Instead of just buying it right here on an aggressive limit order, we would then wait for that double bottom setup to happen somewhere in that kill zone. Remember, it's not always going to be directly at structure, but if we can identify a zone, that's perfectly fine. We'll wait for that double bottom there, and we'll use that as a way to hop on the bigger trend and take it up to our extension. Bearish trend, same thing. Of course, just inverted. The market's flowing. New structure lows, outside return. New structure lows, outside return. We're saying we're in a bearish trend. I know it. New structure lows. We just put in a lower low, lower close. We passed our previous structure level, so it's confirmation that we're in that trend. I know what's coming next. We should get another outside return. Where is this outside return likely to come to? Well, two things. We can take our Fibonacci retracement, swing high to swing low. We can look left, structure leaves clues. Where's our last structure high? Remember, resistance now turns to support. All right, we'll have a nice little zone between, again, my 618 and my structure level. There's probably a good chance that the market's going to put an outside return to this level. As the market starts its outside return, hits our kill zone, stops on a dime. You see this level holds. We get a brief retracement. We then get a retest of that level, giving us our double top pattern. Of course, we have overbought and an RSI divergence, giving us even more confirmation. We sell it next bar market and look for the trend to continue down. And you can see when we talked about targets for our double bottom and double top pattern, we talked about taking the 382 and the 618. But if you implement this simple pattern as an entry technique and not just a strategy to trade, well, again, you can trade this like a normal trend continuation, and you can shoot for much advanced targets. You can shoot for Fibonacci extension. So again, remember, we're taking our Fibonacci extension tool, swing high to swing low here, and we're looking at 127, 1618. So not only is it a pattern, it's an entry technique. And again, you're going to have to experiment. I'm going to give you the default targets to shoot for, but as you get more comfortable with it, I recommend, and I don't recommend, I guess if you want to be a successful trader, you should test out what's the most efficient way to use this setup. So as a trend continuation trader, you're using this double bottom, double top setup as a way to get in with the overall trend. Counter trend traders, we're looking at it a little differently. Counter trend traders, we're not looking to hop on the trend. We're looking to catch the outside return. So we're looking to find, when is this trend going to end? When is this trend going to, not necessarily end, but when is this trend going to run out of steam and give us another outside return, so I can kind of snipe the market and make a little bit of profit. So we're seeing this new structure low, outside return, new structure low, outside return. And remember, every time we get to this level, every time we come off an outside return, this is going to be a crucial decision point. So this is going to be the point in time where if we get a lower low, lower close, we know that the market's trending. If this resistance level holds, then we know we may see either a reversal in trend or some type of consolidation. As a counter trend trader, this is where we're looking for the market to hold. Now, instead of getting that lower low, lower close, we're looking for the market to go oversold at this area of structure, looking left, looking for the market to test that level, retrace slightly, and then test it again, only to be rejected once more. Then we're looking to hop on this trend, or hop on this move, hop on this double bottom, as part of either an outside return or maybe even a complete reversal in trend. So again, where trend continuation traders are looking to enter the trade at the outside return and then hop on the underlying trend, counter trend traders, we're looking for this resistance level to hold and then make a brief amount of profit on the outside return. If we're looking in a bullish scenario, same thing. New structure high, outside return, new structure high, outside return. Crucial decision point. If the market gives us a higher high, higher close, we then have a new structure high, and I know that the trend is continuing. If this level holds, we may either see a reversal in trend or a period of consolidation. And if this has confused you, refer back to your first video. This is the simple stuff, how to read a price chart. Market comes up, say we test this level, it holds. The bears take over for a little bit, we get a brief retracement, and then we test it one more time. Once we get that overbought, once we get that bearish divergence, once we make sure we don't get a higher high, higher close, we now have a valid double top pattern, and we can look to catch the retracement. So 2 scenarios in how you can use this pattern. You can use it as a simple pattern by itself. You can use it as an entry technique. But the key things you want to remember is anything that I teach you, it's not going to be valid just by itself. So I don't want you going out there just trading every double top you see, every double bottom you see, because you're going to get eaten alive. But as you start to combine it with Fibonacci areas and structure and ABCD patterns, then these things start to become more powerful. And later down the road, I'm going to teach you a lesson called the combined technical score, where we're actually putting everything we know together and we're basing our trading off a score-based system. So as always, your action item, go through the charts, rewatch this video. I know this one got a little more complicated because it's a little more ebbs and flows to price action, but rewatch the video, scroll through some charts, practice identifying these levels. Once you can get this down, this is going to be a very powerful tool, even if you don't decide to trade the actual pattern. Even if you just decide to use the entry technique as a way to get involved in other patterns or other setups, this is probably one of the most crucial techniques that you'll learn. So it's important that you have it down. So until then, do your homework, run through, train your RAS, and I'll see you guys next time.